and then we'll talk a little bit about the deals at the end. And then we'll unmute mics and I can do any Q&As that people have. So I'll talk a little bit about what's going on. Every week I do about 10 minutes. If you go to LinkedIn and look me up and just click on my profile, you'll be notified every week for my 10-minute overviews. And I take about 10 minutes and just really connect the dots on what's going on in the real estate world, the distressed debt world, and the economy in general, and how that might be helpful to you. And we get 2,000 to 3,000 people every week, actually, just looking at that for 10 minutes. So most people find it very helpful. And what I'll do today is I'll go into a bit more detail here than I do on LinkedIn, because on LinkedIn, because we're an SEC registered fund, we need to be very careful what we say publicly. And since this is a private forum, I can speak a bit more freely. So I'll talk a bit about what's going on with COVID, what's happening with the reopening of the economy, what's happening with unemployment and rates and interest rates, and what that will mean for the real estate market. I'll talk a bit about what's going on at the fund, and then I'll take a few minutes for Q&A. And I'll try and keep my remarks short. Feel free to ask as many questions as you want at the end. So Albert, can you move forward to the next page? So this is a very important page because we are an SEC registered fund, and there's very strict rules about what we can say and what we cannot say. And so when I talk about returns, and when I talk about anything that has happened in the past, and when I talk about anything that may happen in the future, it's important that you recognize that past performance is no guide to the future, and the value of any investment can go up as well as down. Even holding cash the value of cash can be eroded with inflation over time. So while we have generated between 17.5% and 21% return per year since we started, that may not happen in the future. We're in unprecedented times, and those results could be wildly different going forward. You should read our investment memorandum, our investment memorandum, either on the SEC website or on our website, www.automationfinance.com. Make sure you understand all the risks and make sure that you understand what it is that you're getting involved in. Don't leave any question unasked. With that said, I'll move forward. So Albert, if you can move forward to page 3, just briefly, what is it that this business does? So we're a non-performing loan fund. We buy mortgages. And we buy mortgages where the borrower is not making payments. So I actively solicit every week to banks, to loan servicers, to investment funds, and I ask them to sell me loans where their borrowers are not paying. We typically buy those loans for around 60 cents.
No, I didn't. No, it's just starting back working.
Hey, Albert, would you see if you can figure out to put all the mics on mute? Because it sounds like people are asking questions when they're not. They're just talking themselves. And so we buy these loans for 60 cents on the dollar, and then our job to start paying again. Now, why would they stop paying, and why would they start paying again? Typically, they stop paying because something happens. For example, now with COVID, a lot of people have lost their jobs. They have no income, so they can't pay their mortgage. And that may persist for 3 months or 6 months or 9 months or however long it persists. And at the end of which time they've missed 9 months or a year of payments. And they may not have $10,000 or $12,000 or $20,000 that they can pay in a lump sum to catch up on all their missed payments. And so the bank either has to foreclose, take the house and sell it, which they really don't want to do because banks don't like doing that. It's bad for business. Or they can sell the loan to someone like us. And so we're in the business of buying those loans because we're not a high street name, like I don't want to name any particular bank, but a bank that we've all heard of. We're not going to be in the newspapers for foreclosing because that's just not the way that newspapers work. They're looking for a big name. And so we provide a solution to the bank by buying the loans. We do buy them at a discount, and we share that discount with the borrower. So the borrower is able to get a forgiveness of some of the missed payments, and we can then get them back on track. They've now found a new job. The 10 months of unemployment is over, and everything is back to normal again. And that's basically what we do all day, every day. And so, Albert, can you go to page 4? So we've been doing it for since 2013, and since then we've done 4 funds that have been significant funds, significant in size. We've done some other smaller ones that were just personal money, friends and family. And across that period, we have returned between 17.5% and 21% per year for our investors. That's net of fees. And so those returns have been pretty good. But as I said before, that may not be the case in the future. There may be, we may not be so fortunate going forward. And so you should read the investment memorandum before you consider investing. And we're open for investment right now. It's a fund that is open to accredited and non-accredited investors. You can invest as little as $250, and we pay a preferred 8% return. What that means is you get your capital back and 8% before we get a penny. So that's our target to do that. And we've been raising money for about a year under Regulation A of the SEC Companies Act, and we will continue to do that for another year, and then we will stop raising funds and we will deploy all of that cash. So our timing is just perfect, because at the moment a lot of people are in forbearance, which means their banks are not foreclosing, but that will come to an end at the beginning of 2021. So we're raising funds, we're buying loans here and there, but not as much as we think we'll be buying in the early stages of next year. So Albert, if you go to page 5, just talking a little bit about COVID and where we are in COVID. So the numbers are getting better and better in terms of infection. Most states are finding that their hospitalization and sickness rates are falling. There is a bit of a concern, if you move to page 6, Albert, in some of the states that have opened very quickly and have not adhered to the social distancing. We're seeing a spike in lots of places that are, like, let's say, more rural. So places like Arizona, some parts of New Jersey are seeing spikes, places like Utah and Florida also. And so that could lead to another wave of sickness, but also another wave of shutdown. That will be very bad for the real estate market, because we are currently in prime real estate selling period. And a lost season will mean that there's a lot of people who right now need to sell are going to be either reducing their ask, in other words, reducing the price that they're asking for the real estate, or, excuse me, being forced to miss mortgage payments, and that will result in non-performing loans coming to the market. If you can go to page 7, Albert, it's not just the US. This is the worst recession that we've ever seen since even including 1930. It's also the shortest. 1930 took about 2 years to hit rock bottom. This time around, we've taken 3 months. But that's not to understate the magnitude of what has happened. There are currently 40 million people unemployed. Albert, if you just go to page 8, some of those people are going to get jobs, and there's going to be, for some people, a V-shaped recovery. But I don't think that's going to be the case for the vast majority of people. The vast majority of people are not going to enjoy a V-shaped recovery. They're going to be people who work in face-to-face type businesses like leisure and hospitality and restaurants. And even I can see in Manhattan here, a lot of restaurants, probably 80 or 90% of restaurants are closed right now. But many of them have got for rent signs, not just closed due to COVID. And I don't know, 20 or 30% of the restaurants, and I walk to work, it's about a mile, and I walk by just about nothing but restaurants. 20% or 30% of those restaurants seem to be making plans to not open ever again. They're closing and they're renting out that space. And it's hardly a surprise, Albert, if you go to page 9, this is just a breakdown of the numbers over the last 3 months and where the funds have come from. Where has people's revenue come from as a business? And rather than saying where the money has been coming from, let's say where the money has not been coming from, because it has not been coming from customers. Almost 80% of businesses since the COVID began have sought some sort of state help. To put it another way, only 20% have not sought state help. We've basically got a social welfare state during this period. And that's very bad for almost all businesses. I even think of our own business. Normally I'd be sitting in a room with 16 other people, and there's one other person here beside me today. And that's been the case for months. And many of them have said they won't feel comfortable to come back into New York City because many of them live in Jersey. They're not going to come back until August or until there's an announcement of a treatment that is effective where they can't get infected. I can't think of the name of that for the second, but you know, like an injection that stops you from getting sick. And that could be a year away. Who knows when that will come? And that's for sure really bad for business. If you could go to page 10. So Albert, this is just a mapping of hotel occupancy. And the blue line and the black line just shows the 4-week rolling average of what it's been over 2019 and 2018. And the red line shows what it is right now. And I'm surprised there are even 20% occupancy in hotels right now, because certainly the ones I walk by they've got chains around the door. They're not even open for any reason, never mind to be occupied. They are completely and utterly shut down. And I think that we're going to see that continue. 70% of people are saying that they don't feel comfortable getting on a plane, that they don't feel comfortable going to a hotel, that even if restaurants were open, which they were not, they don't feel comfortable going closer than 2 meters, or 8 feet to people, depending on what country you're in. And the restaurateurs, I know, my own brother's a restaurateur. He says, you're joking. You maybe can get away with 60% full on Monday, Tuesday, and Wednesday. But Thursday through Saturday, you need to be 100% full, or you just won't be able to pay the rent. Because as everyone knows, the restaurant business is not a great business. And certainly with any kind of reduction in capacity, it's just not going to work, period. So I think we'll find a lot of these businesses don't come back. And a lot of people who've been unemployed, who are unemployed right now, 40 million people, it's just extraordinary number of people, are going to either be discouraged and not come back to work, or won't be able to come back to work at all, because the kind of skills that they have don't fit with high-tech app development or something other than the business that they've been in, which is maybe in the restaurant, leisure, and hospitality business. If you could go to 11, please, Albert. And that is just a reflection of a general trend in society, which has been, since the last recession, a general decline in participation, and participation using the economic definition of the word, which is people who don't want to participate in the labor force because they can't find any kind of a job that they see is suitable for them. And you can see on the right-hand side, the far right, a really sharp fall recently in the number of people participating in the labor market. And there's a lot of political pressure to count these people as not being unemployed, but you can call them discouraged workers if you wish, but at the end of the day, they're not working, and they're not so old that they can't work. They're just not working. And I think that we'll see that trend may recover somewhat, but I don't think there's going to be a V-shaped recovery. There's going to be a U-shape, and the flat part at the bottom of the U is going to go on for quite some time. And if you go to page 12, please, Albert, that will exacerbate something that we've seen even since 2008. So this chart here just shows negative equity across the US. What states are negative equity, what states are not. And the average home since 2008 has increased in value by $100,000. So the average home in the US today is about 300 grand. So it's gone up from 200 grand to 300 grand in the last 10 years, which is a pretty stellar recovery. But there's still tons of markets that have negative equity. And with this reduction in income for 40 million people, the number of people buying new homes at the medium and the bottom end is going to be flat or down. The people at the high end, they're, I think, in real trouble. Multi-million-dollar homes, I'm already seeing non-performing loans, even right close here in lower Manhattan. I haven't seen any. In the last recession, I saw none. And now I'm seeing homes on Central Park West, which is Billionaires Row, coming to market. One I saw 2 weeks ago, $6 million, 1,800 square foot apartment, $4 million mortgage, and I can buy that mortgage for $3 million. So you buy the loan and you get control of a $6 million apartment for $3 million. Now, you need the $3 million. It's a cash deal. You can't go and get a loan to buy the loan. But you get the idea that there's certainly distress at the high end in that market. And if you go to page 13, and that will play out across all high-end markets. So places like Miami on the top left, you know, the expensive Northeast, Boston and New York, and places where multi-million-dollar apartments exist, anywhere involved in the oil business and anywhere in leisure. And watching the stock prices for Sands and a few of the casino operators in Las Vegas, they've been recovering pretty well, as have the cruise lines and some of the airlines. But I think that we haven't seen the bottom yet. There's going to be another wave of, maybe not sickness, but when all of these social welfare type payments run out, and there are no jobs coming back, or jobs are coming back slowly, the market for second homes, the market for casino gambling, the market for non-essential payments, I think we'll see is curtailed, and curtailed quite rapidly. And that will inevitably, as night follows day, mean that there will be another wave of mortgage defaults. It may not be as bad as we saw in 2008, but we're already seeing today 16% of mortgages either inquiring or in active forbearance. 10% are in active forbearance, and then there's a whole bunch of backlog. Now, the good news is new cases have fallen to a trickle. There's very few new cases coming, but that's still 10% of mortgages in forbearance, which is the same number of mortgages that went into default in 2008. So it may not be the same as 2008, but I think it will be somewhat similar. So moving then to just some deals and why we think this is an interesting space for right now. So if you could just go to page 14, please. And this one has a build on it. And so people ask, could I just run through some actual examples of deals that we've done? And so this is a deal, I've just titled it Lost in the Shuffle. And we bought this from a public company. They're a loan servicer, multi-billion-dollar business. And as I say to you, I go to them all the time and say, hey, have you got loans that are very troubled that you just don't want to own? And we bought 10 loans from this one, 10 loans from this one seller in February, closed actually in March, but we did the deal in February. And this is one, it's in Boston. I've blanked out the address because this is a live active deal and we've data protection, but it gives you an idea. It's a 3-story home. It's about 3,000 square feet, 4 bedrooms, and very nice home just outside of Boston. And Albert, if you could just click the bill so that you can see the box on the right, which explains a bit about the background. And so this was Mom's home, and she was on limited income and had multiple generations living with her, 2 generations living with her. And she had gotten into difficulties bizarrely in 2008, and here we are in 2020, and there was still no resolution. And they'd been foreclosing on the home and then stopping the foreclosure and negotiating with the borrower and then starting foreclosure again. Crazy, really, stuff. But the problem that that servicer had is it's a very big company and they have very strict guidelines, and they couldn't get the borrower to qualify because she had very limited income. And the house was worth about $1 million, and the loan, because it hadn't been paid in so long, had now gone up to $1.2 million. And this lady had lost over $100,000 of equity because previously, when she stopped paying back in 2008, she'd actually paid the mortgage down quite a bit, but it had ticked up from it was at around $700,000 when she stopped paying. And it had gone all the way up to now 1.2 million. So we bought this loan in February, and it was actually March, but we agreed the deal in February for $460,000. And because we're not a bank and we don't have anyone to report to and we don't need to qualify borrowers, so long as the borrower can afford the payment, we can do the deal. And so, Albert, can you click just to bring up the solution that you can see there? So what we did was we modified the loan to $700,000. So that created $300,000 of equity for the borrower instantly and saved them $200,000 of negative equity. So they've gone from a position where they were losing their home to one where they're now at equity back in their home. And why did we do that? The reason we did it was because the inside of the house was not in very good shape. And while Zillow tells us that it's worth $900,000, Zillow is only a very rough estimate. When you actually get an appraiser out and go through the home in detail, it needed quite a bit of repair, and either we would have had to repair that home if we were to take it back in foreclosure and sell it, or a new buyer of the loan is going to do their own due diligence and reduce the price. So we agreed the value of the house was $700,000. The homeowners were able to get $50,000 together, and we gave them a modification of their loan of $650,000. So the total sum involved was $700,000, $50,000 up front, and $650,000 over 30 years. And that got the payment down to around $4,500, which they were able to afford because there were 2 generations of people working in the home. So it was 4 incomes coming into the home. So what will we do with that loan? Well, we'll hold it for a year and we'll sell it in 12 months. And our total return will be around 40%. So that's a really good return for us, particularly in Boston, because Massachusetts is a very, very tough market to foreclose in. And our general principle as a fund is we always try to work with the borrower. Our objective is to get them back on track and back paying again, not to take their house and sell it. And that's good for society, but it's also good for business, because it takes a long time to sue people. It takes a long time to foreclose. There's a lot of costs in it. And while you may make a little more money over the period of time, it's a lot more work. And it would mean we'd need more staff here and our legal fees would be higher. It's a lot cleaner and it's a lot quicker if you can get the borrower to work with you and you can get them back on track. And a 40% return, I'm actually being very conservative. It's probably going to be a good bit more than that. But when you've got a wide margin, it's better to be conservative. And we're working just to finish this deal right now. If I move on to the next page, Albert, if you just click on to the next one to give you an idea of, don't always show the upside, always show the downside as well. So this is another home actually in Maryland, and I've titled this one No Surrender. So we bought this, we knew we were in for a real battle. This home came from the same seller as the last time, and they'd already foreclosed. This borrower had not made payments since 2010. Really nice home, as you can see there. And the foreclosure was completed in 2015. And the borrower had been fighting for 5 years to stay in the house. And what they had done was there were 7 people living in the home, a very large family. And the way they had fought against the eviction, which the previous owner was doing, was they were using technicalities of the bankruptcy law. And so each person in turn was filing bankruptcy. And without getting into the very great detail of the bankruptcy law, the courts will allow each person to file bankruptcy twice. And each time you file, you will typically get a 90-day extension. So you've got 7 times 2, that's 14 filings times 3 months. So you're out at almost 5 years of just bankruptcies. And the end of that 5 years of bankruptcies, the court will say, eventually, enough. You guys are playing games. You're just filing bankruptcy, then not completing it. And the reason they do it is because it's cheaper to file bankruptcy than it is to pay the mortgage or to leave. And so we just continued to negotiate with these people, but they weren't really engaging. In the end, we offered them $50,000 to leave. They wouldn't accept $50,000. So the courts have been closed will reopen in August. The courts have told them that they are not allowed to file bankruptcy anymore. And in August, we will take ownership of this house. The house is worth about $700,000. We will list it for $600,000 and we'll sell it for somewhere $560,000, $570,000. $600,000 is actually a really good price for this house. It's a very nice subdivision and it's one of the bigger homes there. And we'll have owned it by then. We'll have owned it for, let's say we'll have owned it for a year, probably be only 6 months, but we'll make 30% in a year, maybe a little bit better. And that's one where the deal is a war. And there's other wars. Some of them go really easily. We had a deal today, just before I got on the webinar. We just bought the loan last week, and in 5 days, we've already got a deal done with the borrower. So the deals can be all over the map. Sometimes you get them very quickly. Sometimes they take a really long time. And we have one loan in Brooklyn where we're into year 5 of owning it. And we're just about to, when the courts open, we'll get that property back. And I think we paid $500,000 for the loan, and the house is worth $900,000. So it's taken a long time, but we will double our money, just about double our money on that deal. And so these are the kind of deals, some easy, some hard, and they can take a long time to go through. Sometimes you can get through them very quickly. The key thing for us is being super organized and making sure we're on top of all of our dates. So we have a system that tracks all of our dates. We have a system that manages all of our 112 law firms that we work with around the country. And our objective is to get a deal with the borrower. And if the borrower says, hey, take a hike, I'm not working with you, then the only thing we can do is foreclose and try and get through that foreclosure process as quickly as possible. So Albert, if you go to page 17, so what does all of this mean? I'm doing this webinar to spread the news about our reperformance fund. We'll be closing it shortly. because we've quite a bit of cash. About 90% of all of our funds is in cash right now. We've been working on deals since February, but the deals have not been closing. The sellers have struggled to get permission to close the deals. So we're in a situation right now where we've millions of dollars in the fund bank account and we're paying interest, but we're not deploying it. So we haven't bought loans. We bought one or two here and there, but typically we'd be buying pools of loans, multiple loans on a weekly basis, or at least on a monthly basis. And that has not happened. The deals in February collapsed, the deals in March collapsed just because of the COVID difficulties. So we'll be continuing to fundraise for the month of June, and we will close the fund in July. We're allowed to close it just for a month or two until deals start coming back. So this will be the last webinar that we do. We'll raise funds. We'll continue to pay our target return, which is 8% interest. And we pay that every month, or if you would prefer, we will just keep it in the fund and pay interest on the interest. So you're compounding that return. And we'll continue to do that up until we start committing new cash to new deals. We think there'll be some opportunities in the next 3 to 6 months. We think the market will really start to heat up after that. And it can take 3 to 6 months to get deals really going, because you've got to get the seller to agree to sell. Then you talk about the population that you're going to transact on. Then there's a period of due diligence, which can be 6 or 8 weeks. So this is a long lead time business. We'll continue to do what we've been doing so far, which is buying mortgages, which are secured on homes, where we're paying about 60 cents on the dollar. And so if I said to you, do you want to buy houses, or, finished houses for 60 cents on the dollar, people understand that instantly. The wrinkle here is we're buying the mortgage, and the mortgage has a big benefit, which is once the mortgage starts paying again, you're not worried about maintenance, you're not worried about tenants, you're not worried about taxes and insurance, because the homeowner pays all of those things. The downside is you've got to work with the borrower to get them back paying again. So there's pros and cons to everything. The fund itself pays a preferred return of 8%. We offer best efforts liquidity. So that means if you commit your funds and you come back in a year and 3 months or 6 months or whatever and say, hey, listen, I need to withdraw all or some of the money, we'll work with you to do that. We actually charge a fee to do that, which is you lose 1 percentage point of your interest. So you were expecting 8% in your target return. It's going to be reduced to 7% if you decide to withdraw early. And we've had, I think, 2 investors have withdrawn money under that scheme. So it's a best efforts liquidity, because it's dependent on us having the funds to do so. When you buy a lot of loans for the first few months, there may not be any funds to redeem because you've spent it all buying the loans. So there's always that risk. There are many risks. Please do read the prospectus. And so we'll continue raising funds, and there's about 3.5 years to go to run on this fund. So we'll continue to buy loans, and then we will liquidate them and then start to pay the money back. And the way that the payback works is you get your 8% return, then you for each year. So let's say 3 years at 8%, and then you get your principal back, and then anything left we keep. So anything that you get is net of any fees or any profits for us. We get paid at the end last. So there's a big incentive for us to do it quickly, to return the monies fast, because then we get to keep whatever is left over. So I'll stop there, and I'll ask Albert if you would open up the mics, and anyone who, if you have questions, if anyone has questions, I'm more than happy to answer them.
Yep, certainly. I will unmute everybody, and if you have questions, you can type it into the chat, or you can use your audio as well.
Hey guys, this is Barry. Can you guys hear me?
Yeah, Barry.
So thank you very much for the deep insight. That I really appreciate that. Now let me ask you this. So how do you see this market behaving in the next 6 months, the real estate? Because again, as you said, like there is mortgage forbearances there, no eviction at the moment. How do you see the real estate market of this country in general in, let's say, next 6 to 12 months, or let's say in 2021? Is it something, I mean, I don't expect it like to be crazy like 2008, 2009. But where where do you see that home prices will fall? They're gonna be steady, or what it is? I'll appreciate that if you can put some more insight on that.
Well, look, the most important thing is no one knows. But let's say about the good news. The good news is interest rates on a 30-year mortgage, I think, were 3.15 last week when I checked last. I'm pretty sure that's the lowest rate of a 30-year mortgage in the history of this country. And I think that will drive a lot of people out to buy homes. And I think it will put a lot of pressure, particularly on entry-level homes, those below $200,000. I think it will put a lot of pressure on prices, because when you compare a mortgage at 3% on a $150,000 home, you're talking $500-600 a month in payments instead of maybe $1,000 a month in rent. So that will drive up the price of those houses. I think that will be the case, assuming that there isn't another big wave of corona. And I think that there's a fundamental misunderstanding in the market, leaving aside real estate, because real estate is a derived good. And by that, I mean, it comes as a result of something else. Yes, you need shelter, but if there's mass unemployment, for example, the 40 million people who are unemployed right now, I don't think they're all coming back to get jobs in a V-shaped recovery. I don't think anyone thinks that. Their income from their jobs, it goes into the economy and supports all the companies in the economy who pay salaries for workers. And I think a lot of those people won't be coming back. I think that the companies will figure out ways of running their business with fewer people. I mean, look at this business. There were 16 people sitting beside me, and now there's one. Now, most of them are working remotely, but we've had 2 people say, look, I just don't want to come back to New York City, and they've resigned. They're going to get jobs outside of the city. So it's very hard to predict what's going to happen. I know that interest rates are super low, and that's good for the real estate market. But I also know that this is an enormous economic dislocation, and I think it will be very hard to predict what's going to happen to real estate prices if you just try to isolate real estate prices. I think if you look at the economy in general, incomes, everyone's incomes, could go down. And that could be a very negative thing for people buying homes, paying mortgages, paying rent, paying office rent, going to the mall. So it's very hard to try and model what that will mean at the end of the day.
Thank you very much. No, that definitely makes sense. And one thing which is a little bit worrying me is like number of infection rates are getting higher now since we opened the economy, right?
Yeah.
And to be honest with you, I think no country in this world can afford a halt on an economy. I mean, everything will collapse. So I don't see any other lockdown coming down the road, which means things will work. I think ultimately people will have to take care of themselves, which I assume that people will get afraid and they won't go out, again, if something like that. And so that's something which confuses me a lot. If that is the case, then which means, of course, less income for the business holders. So I don't know. These are the few things I think I thought, like, let me check with you. What's your thought on that in respect to real estate, or in respect to the recession, or whatsoever it is? So since you work in that domain, I'm pretty sure you have at least deep insight than a regular person outside. I hope my question makes sense.
Your question makes perfect sense. I'm not sure anyone has any idea what's going to happen. All you can do is look at the past, and we've never had a pandemic like this before. We have had low interest rates before, and low interest rates correlate with great growth in the real estate market. So we know that. But what happens if you have low interest rates, but no one's able to borrow because so many people are unemployed? We've never had that before.
Got it. Thank you very much.
You're welcome. Any other questions? Great. Well, either I did a great job or people are going to go get their lunch. So Thanks everybody for joining. If you would like a copy of the slides, if you would like to discuss the fund, please just send a mail or put it in the chat, and we'll reach out to you. And we look forward to working with you. If anyone is interested in investing, please do make sure to read the prospectus, and we'll look forward to working with you in the future.
Great. And we will make
Thanks,
the
everybody.
recording available.
Oh,
Thanks,
yeah,
everybody.
the recording will be available too. Yeah, thanks,
Yeah.
Albert. That's a good point. Yeah.
Thanks, Paul.
Thanks, everybody. Bye.
Thank you. Bye.